JP Morgan, whose shares are up 4%, Morgan Stanley both beating on the top and bottom lines. Wells Fargo fractionally in the red, missed on revenue estimates. And with all the uncertainty we're now seeing, our next guest is identifying which financial names more exposed, maybe more vulnerable than others. Joining us now is Commerce Street Capital CEO Dory Wiley. Dory, it's good to have you, and maybe you can position this in how you're thinking about the markets more broadly going into the weekend.
Sure. Thanks, Kelly. Nice to be here. Obviously, the flagship is JP Morgan, and we got a great number out of them. They had a nice beat. They had a one-time extra deal for the First Republic acquisition. Net interest income was up. Investment banking was up 10%. Equity trading up 48%. And the big positive was they were up on loan provisions, which makes the bank safer. One of the things I really haven't talked a lot about is tangible equity in the public markets. I want to bring it up now because I'm very happy where JP Morgan is at a 7.8% number. Just as a reminder, that number was closer to 5% in March of 23 when we had the bank failures. So I think the big banks are looking really good. It's a good trend for all of them, and they're well positioned to move forward.
Is it weird we're talking about how well-positioned the big banks look while also talking about recession risk, awful consumer sentiment, whether the Fed needs to do more to support a falling dollar than a strong one, all of these things that are usually more symptomatic of weak economy and weak financial markets?
Well, as a bank analyst, it's pretty easy to get negative about things, but I'm not sure where all this recession risk is really coming from. Banking is the plumbing and wiring of the economy, and the banking looks really good. Big banks and small banks. Now, we all have this question mark about tariffs and what that's going to do. And the market decides, hey, the tariffs equals inflation equals, problems. And so I'm not sure that I want to buy that. The market seems to remember only one thing with tariffs, and that's Smoot-Hawley. And I think we need to just go back as recent as 2018. Trump puts in 25% tariffs on China. Market adjusts for a little bit, gets a little wacko, and then it's up 31% in 2019. I think we're going to be just fine. China's having obviously a rough reaction here, which tells us a whole lot about their real intentions here versus all the rest of the world.
And Dory, it's Dom. I'm an optimist as well as you know. We've talked over the years a lot. I wonder, in this kind of an environment, where is the opportunity? Being optimistic about where the markets are?
There are opportunities. Let's start with data, right? Anytime you hit a VIX of 40, your odds of making money really go up in a 1 to 3 year period. Short time, it's hard to time the market. But if that VIX goes over 40, you buy your favorite stocks. And when you do that, your chances of recovery really go up. Over a year period, your chance of return is a 20 to 70%. I like to think 3 years just to give me a cushion. And 50 to 80% returns are on average. So think 1998, 2000, 2011, 2020, those kind of markets. And so unless there's something fundamentally wrong with the economy or that company, buy your favorite stock. So a perfect example is NVIDIA, right? We've done the analysis. You probably had people on about the effect of tariffs on NVIDIA, and they're less than 5%. Some are saying less than 2%. That stock drops down where it is now and back even down in the 90s. You step up and buy that.